Hello, everybody. I've got a bit of an alarming article to read out to you from two different parts of the world. First one is Australia. It starts with house prices heading for worst fall in over 40 years, Jarden. The housing market correction already underway could accelerate into the largest on record with a peak to trough decline in prices of 15 to 20%, and even more in Sydney and Melbourne as borrowing costs rise more sharply, according to Jarden. The analysis by the major investment bank comes after Reserve Bank Governor Philip Lowe revised forecast inflation higher to 7%, while sticking to the central bank's expectation that the cash rate will hit 2.5%. Let's remind ourselves that the current rate is 0.85%. So from a 0.85% to 2.5% is a long way percentage-wise as an increase. Also, my other video, I'll link it up there. Philip Lowe mentioned that I think about 6 or 12 months ago, he said that they would not be raising any rates until later to 2024 or even beyond, but they've jumped the gun. And as I mentioned in my yesterday's video, they're probably going to be jacking the prices up or the interest rates up a lot further before they realize that that's not working for them as far as stifling the inflation, because this inflation is not the speculative type inflation, but it is, according to some, a supply shortages because of the supply chain shortages. Um, so that's high interest rate is only going to put the fire or fuel on the fire for the inflation that we have now, and it'll probably crash the property market and a few other markets while it's at it. Oh, by the way, this article was actually on Financial Review. It was sent to me by my mate over from London. Like I mentioned in my few previous videos, he continues to watch, especially Sydney property markets. He hopes that it will pull back so he can get back in and move over here. But yeah, so Financial Review, I'm going to leave a link to the Financial Review um, article directly in the description. However, I'm a bit technical that way, so you'll notice that this is on archive.org or Wayback Machines, because unless you have a subscription, you won't be able to see this article. However, I'm actually reading it straight off the Wayback Machine, so that's quite handy. Our forecast rate hikes would see around 25% um, fall in borrowing capacity by end of this year, 2020, with a further downside risk as banks update their household expenditure measure, HEM, for higher essential inflation, he wrote. So the households have higher expenditure means that they have less of the disposable income or income to spend or to be able to service loans once they get a mortgage. Here's a bit of a punchline here. This is likely to flow through to faster and larger house price falls than we earlier expected, and we now forecast prices will fall around 5% by the end of 2022 and further 10 to 15% over 2023. It was 10% earlier. So for a total of 15 to 20% peak to trough decline. Well, actually, the punchline continues. Price declines in Sydney and Melbourne were likely to be larger and faster. So larger and faster than 15 to 20%. This would be the largest house price correction since at least 1980s or 1980 in both real and nominal terms. Following Dr. Lowe's comment on Tuesday night, markets are now pricing a further 50 basis point rate jump when RBA, Reserve Bank of Australia, meets in July. The Jarden, which is this major investment bank view, chimes with an increasingly bearish view on house prices in recent days by other analysts. Last week, Commonwealth Bank downgraded its forecast after the RBA lifted the cash rate by 50 basis points, a steeper hike than expected. Now back on the CBA forecast. On CBA's forecast, Sydney's house prices could drop as much as 11% this year, 2020, and Melbourne's prices by 10% by the end of 2023. So by the end of next year, Sydney and Melbourne prices are expected to slump by a total of 18% each. All right, I'm not going to read you the whole article. Like I said, I'll post the link to the Wayback Machine where you can actually read it without subscription to Financial Review. But I'll read you a few others before we move on to another country of this world. But yeah, the housing downturn will spill into the new home sector as well, according to Jarden. Now, we know that about 5 builders have gone belly up since probably in the last 8 months or so, or a bit longer. And so that's not looking good for them, along with rising rates and falling house prices, surging construction costs, combined with the after effect of the preceding house building boom, are likely to see a material fall in building approvals ahead, Mr. Cacho wrote. This is an analyst inside the Jarden bank. Jarden has forecast a sharp fall in building approvals to around 130,000 expected annualized, comparable to the decade ago before rebounding to 180,000 by the end of 2023. But let's just look back and remember that this has happened before. These doom scenarios were predicted even by the mainstream. Back in the 2019, they did predict, and the prices did pull back about 10, 11%. So it's not insignificant. After the prices rushed up 25 or 30% in a little bit over a year and a half, this doesn't sound like a huge pullback, even if it eventuates. But what if it occurs in much larger numbers than what they're predicting here? Over to Yahoo Finance. This is Yahoo Finance in the US. The housing market reset has become a bit more than that. This really ties into what I said in my yesterday's video. But yeah, the Federal Reserve is trying to slow the economy, and the housing sector is bearing the full force of these actions right now. I mean, they're trying to slow the economy. I mean, the economy is not really going anywhere fast. The inflation is. So they're trying to slow the inflation by slowing the economy, which is not going fast anyway. They don't see. I wouldn't say they don't see it. They're very smart, intelligent, educated people. But if I put my conspiratorial hat on, they probably are looking to instigate some sort of a reset. I mean, we've heard that before, but they do need to see it kind of hit the bottom before, and for most people to feel the pain before they can actually provide some sort of a solution that everyone's going to be asking for. Costs are rising for buyers, confidence from builders is falling, list prices are getting cut, and if the idea that the housing cycle is the business cycle holds any sway, the road ahead does not look pretty. All right, the Census Bureau in United States actually came out with a report, and it showed that in May, the pace of new home construction fell by 14% from April to its lowest level in a year. In the mortgage market, things are even more challenging. Data on Thursday from Freddie Mac showed that the average rate on a 30-year fixed mortgage rose to 5.78 last week, the highest since November 2008. We know what happened then. And marking the largest 1 week increase since 1987. And we know what happened in 1987. So US mortgage rates see largest 1 week increase since 1987. And that's what that looks like. It's pretty steep. And this statement is a little bit weird. In a press conference on Wednesday, Fed Chair Jerome Powell said the housing market is experiencing a reset. What does he mean by that? The data published Thursday suggests to at least one economist that reset might not be a strong enough word to describe the dynamics taking place in the housing market right now. Gee, sounds really bad. This is what the analyst said to say. The next few months will bring further steep declines in housing construction given the collapse in mortgage demand. Chair Powell yesterday said the housing market is undergoing a reset. It's much more than that, this analyst said. All right, the next one is a very important thing that Powell said. He says, I would say if you're a home buyer or a young person looking to buy a home, you need a bit of a reset. Powell said on Wednesday, we need to get back to a place where supply and demand are back together, where inflation is down low again and mortgage rates are low again. So this will be a process whereby we ideally do our work in a way that the housing market settles in a new place and housing availability and credit availability are at appropriate levels. So they want a housing market to settle in a new place. Now, I'm not sure that's actually going to happen because in the United States, I think the dynamic is a little bit different. The prices have gone through the roof. I hear that these big hedge funds like BlackRock and the others that have, $1 trillion under their management, uh, have been buying. So Wall Street has pretty much have buying the housing. They didn't care if they were paying 20, 30% more above the asking price or the market value, whatever that is, because they knew they would eventually capitalize and they would actually suck up all the availability in the market, which means that the real people like ourselves wouldn't be able to compete with the prices that they're paying, and or there just wouldn't be a supply for us to buy there. So instead of buying, we would be renters, and once we are renters, we have no choice, and that apparently is happening a lot. I was listening to this report and somebody was saying that one bedroom condo in Vegas is about $1,800 a month rent. Now, I don't know what's included in that rent. That's US dollars. And to be honest, that's almost pushing, if this is true, pushing more than Sydney. And Sydney is one of the most expensive towns where Las Vegas is, for example, is a kind of a more of a blue collar, entertainment, not a highly paid um, employment kind of place like East Coast, West Coast, that sort of stuff. So if that's true, that's it just goes towards the story where yes, the Wall Street is buying up the property and then they're leasing it out at increased prices to the rest of us, unfortunately. And we kind of don't have choice right now. But if these prices do go back down to some sort of a acceptable level, as Powell says, settles in a new place, lower, hopefully, people will be able to get back into the market and at least buy their first home. Let's not talk about the investment because, yeah, we need to get people into their first home and to be happy in it, as opposed to, having some investor buying their sixth home or the hedge funds mopping up the rest of it. But